Have you ever dreamed of earning passive income from real estate without ever having to manage a single property, fix a leaky faucet, or chase tenants for rent? Welcome back. Today, we're diving into SCPI, or Société Civile de Placement Immobilier, a powerful and increasingly popular way to invest in real estate in France, but without all the headaches of being a landlord. So, how does an SCPI work? What are the risks and returns? And more importantly, is it the right fit for your financial goals? Stick around because we're breaking it all down in simple terms, with real-life examples, so you can understand everything, even if you've never invested a euro before. Before we dive into today's topic, please note that the information provided in this video is for educational purposes only. It is not financial, investment, or tax advice. You should always consult with a licensed professional before making any financial decisions based on this content. An SCPI is basically a way to invest in real estate without actually buying a building yourself. Let's break that down. Imagine a company that owns dozens, sometimes hundreds, of office buildings, stores, healthcare facilities, or even apartment blocks. When you buy shares in an SCPI, you become a partial owner of that entire real estate portfolio. The SCPI handles everything: buying the properties, renting them out, collecting rent, managing repairs and tenants, and you sit back and receive your share of the rental income. Think of it as owning fractional real estate, managed by pros, perfect for people who want to invest but don't have the time, money, or energy to buy property on their own. Investment options. Now let's talk about how SCPI investments work in practice. There are three main types of SCPI, and each serves a different purpose. 1. SCPI de rendement, yield SCPI, the income generator. This is the most common type. Invest in commercial real estate, offices, retail stores, logistics centers, etc. Goal: provide a steady income to investors, often 4% to 6% per year. Use case: Claire invests $10,000 in a yield SCPI. She receives quarterly rent payments like a dividend with no landlord headaches.
2. SCPI fee scale, the tax reduction tool. These are designed specifically to help you pay less tax if you live in France. They invest in residential properties that are eligible for French tax incentives like SCPI Pinel, new properties in high-demand areas. SCPI Malraux, historic buildings under renovation. SCPI Deficit Foncier, old buildings needing major work. How it works. You invest a lump sum, and over the next several years, you'll receive tax reductions on your income. But unlike yield SCPIs, the rental income is much lower, especially at the beginning. Use case: Julian earns €60,000 per year and pays a lot in taxes. He invests in a SCPI Pinel, which gives him a tax credit each year, reducing his tax bill over 9 years. Great if your main goal is tax optimization, not regular income. 3. SCPI de Plus Value, the long-term growth bet. These focus on buying undervalued or aging properties, often residential, that are expected to increase in value over time. Rental income is low, but the idea is to sell the properties at a profit later. How it works. You invest your money for 10 to 15 years, and when the SCPI sells the portfolio, you earn a share of the capital gains. Use case: Sophie is 35 and doesn't need income right now. She invests in a SCPI de Plus Value, hoping it will grow significantly by the time she's nearing retirement. Great for people with a long-time horizon who want to build wealth. Benefits of SCPI. Let's recap the benefits, now including the specialized SCPIs. For yield SCPI, SCPI de rendement. Stable passive income, like a real estate paycheck. Diversified portfolio, spread across multiple tenants and sectors. Great for retirees or side income seekers. For SCPI fee scale. Lower your income taxes, especially useful if you're heavily taxed. Invest in French real estate indirectly. Use legal tax loopholes without buying an entire apartment. Often includes beautiful or historic buildings in sought-after cities. Note, you must hold these investments for several years, usually 9 to 12 years, to benefit fully. For SCPI de plus value, focus on capital appreciation rather than income. Ideal for long-term investors who don't need immediate cash flow. Can be very profitable if property prices rise significantly.
Drawbacks of SCPI. But no financial product is perfect, right? Let's talk about the downsides. Not risk-free. If tenants stop paying or vacancy rates go up, your returns can decrease. Low liquidity. SCPI shares can be harder to sell quickly. This is a long-term investment, usually for 8 to 10 years or more. Fees. Entry fees can be 8 to 12% of your investment. Yes, that's a lot. So SCPI is best for long-term investors. Taxation. Rental income from SCPI is taxed like traditional property income. We'll break that down shortly. Example. Mark invests $20,000 in an SCPI and needs to sell after 2 years. He might not find a buyer quickly, and even if he does, he could lose money due to entry fees and short-term market fluctuations. How to start investing in SCPI. Getting started with SCPI is pretty straightforward. Here's how. Choose a platform or financial advisor. You can go through a traditional bank, an online broker, or a real estate advisor. Provide ID documents, typically passport or ID, proof of residence, and your French tax number. Select your SCPI, based on risk, return, and type of properties. Fund your account. Minimum investments range from $1,000 to $5,000, depending on the SCPI. Sign and invest. Once approved, you're officially a real estate investor. Good news, this can usually be done entirely online in less than a week. How to withdraw or exit. So what if you want to sell your SCPI shares? Well, it depends on the type of SCPI. For a capital variable, SCPIs, most common, you can usually sell your shares back to the SCPI itself. For others, you'll need to find a buyer on the secondary market, which can take time. Important. You might need to wait several weeks or even months to sell your shares, and you could lose part of your investment if you sell too soon. Taxation. Let's break down the tax part. No one's favorite topic, but super important. Rental income. Tax. SCPI earnings are taxed just like if you owned the real estate yourself. That means income tax, based on your bracket, plus 17.2% in social contributions. Double taxation for non-residents. If you live abroad, you might be taxed in both France and your home country depending on treaties. Capital gains. If you sell your shares for a profit, you'll pay capital gains tax, just like with real estate. Tip. Some people invest in SCPI via an assurance VA, which can offer major tax advantages.
Comparison with other products. Now that you understand how SCPI works, you might be wondering, how does it compare to other popular financial products in France? Let's break it down in simple terms. If you're looking for a super safe place to store your money, where it stays available and risk-free, the Livret is still one of the best options. It's government-backed, completely tax-free, and you can withdraw money whenever you want, perfect for an emergency fund. But here's the thing, the returns are very low. So, it's not meant for growing wealth, just for parking cash safely. Now, if you want to invest in the stock market and benefit from tax advantages, a PEA or plan d'épargne actions could be a great fit. It allows you to buy stocks or ETFs, and after 5 years, the profits you make are tax-exempt on income tax. It's more volatile than real estate, of course, but it can offer higher returns, especially over the long term.
Then there's the Assurance V, a really popular product in France for long-term saving and investing. It's flexible, offers tax benefits after 8 years, and lets you invest in both secure options and risky ones. Many people use it for retirement planning or to pass on money to family with fewer taxes. Compared to these, SCPI stands out because it's one of the only ways to invest in real estate without owning a physical property. You're not buying stocks or holding cash. You're putting your money into real buildings, rented by real tenants, and earning rental income. That makes it unique. But here's what you need to remember. SCPI usually doesn't offer any special tax benefits unless you invest through an assurance VI or choose a SCPI fiscal. And unlike a Livret A or even an assurance VI, it's not liquid. You can't just pull your money out instantly. You need to commit for several years. So in the end, it depends on what you're looking for. If you want stability and security, go for Livret A. If you're aiming for stock market growth with tax perks, check out a PA. If you want flexible, long-term savings, maybe for retirement, Assurance V is great. But if you want passive income from real estate, or you're looking to diversify your investments into property without the hassle of buying a home, then SCPI could be exactly what you need. It's all about choosing the tool that matches your goals. Final thoughts. Please note that the information provided in this video is for educational purposes only. It is not financial, investment, or tax advice. You should always consult with a licensed professional before making any financial decisions based on this content. To wrap things up, SCPI is a smart way to invest in real estate, hands-free. It's great for long-term passive income, but it's not for everyone. It's illiquid, taxed, and best suited for people with a multi-year horizon. If you're just getting started, start small. Do your homework, and maybe even talk to a financial advisor to make sure it fits your goals. That's it for today. If you found this helpful, don't forget to like, subscribe, and leave a comment with your questions. I read every one. Until next time, happy investing.